Management. Ted, welcome back. Good to see you. So October was a rough month. We saw a surge in unemployment claims, which some blamed on hurricanes. What do you think about these latest figures?
Well, like you mentioned there, the initial claims came in a little bit lower than expected. I think that sideways word is a good word to be using. But what I've been looking at too is the continuing claims, which is actually at about 1.9 million, which is actually a marker since November of 2021. And so it actually is showing a cooling in the jobs numbers overall when we look at those continuing claims, and has huge ramifications when it comes to of course, the Fed's upcoming meetings in January with interest rates, where we're going to go in 2025.
So are we seeing the Trump bump in employer confidence, or is it too early to make that claim?
I think that, I think there absolutely has been a Trump bump. If you look at the markets, of course, there's a ton of money flooding into risk on assets because I think the markets are starting to assume a lot of stimulatory, economic policy. Trump has mentioned bringing down the corporate tax rate from where it sits today above 20% down to 15. With the election as being as decisive as it was, I think the markets can assume some of that, a lower regulatory environment and those types of things. And of course, that affects employers too.
So the Fed cutting interest rates recently, you would think that mortgage rates would be falling as well, but they're not. What's going on?
I think it's a really interesting point because the conversations I'm having with folks every day reflect a similar question, right? Hey, the Fed's lowered rates down 75 basis points the last couple months. Why are mortgage rates like almost spiking? And I think it's ultimately because, at the end of the day, because of the amount of spending that we've had over the last several years, the markets are digesting that as long-term inflationary. And as more and more assets are looking toward, I'll say more aggressive positions, they have to, investors have to be able to find yield somewhere. And so we see the 10-year treasury now at about 4.5. And when I compare that, of course, the treasury being the risk-free rate of return, to where we would expect other, credit instruments, maybe junk bonds or credit rated bonds, the spread between where the 10-year treasury is and those is at a 17 and 26-year low for junk bonds and credit bonds, respectively, which of course is going to push that mortgage rate higher.
Speaking of long-term inflation and the Treasury, some argue that inflation concerns associated with Trump's policy proposals have increased benchmark Treasury bond yields, which plays a role in determining home borrowing costs. And that's why we're seeing mortgage rates go up again. What do you think?
Well, I think that there has been this emphasis for the incoming Trump administration, of course, on efficiency in government. And we think about, Elon Musk and Vivek being assigned the efficiency, department essentially. And I think that what the market is basically doing is trying to wait and see how effective they're really going to be. Because at the end of the day, between Social Security, between Medicare and military spending, that's 2/3 of the budget right there. So even if we do make significant cuts, is that government spending ultimately going to be able to be lowered far enough to have well, I'll say an anti-inflammatory or inflationary rather effect, if that
Well,
makes sense?
what about the tariffs as well?
Sure, absolutely. I think that the tariffs are one of the top things when people think about inflation. And at least on that specifically, I'm still kind of waiting to see exactly how much tariffs we'll actually see. Obviously, Trump has talked a lot about it, but at least if we look at back at the last term, yes, there were tariffs, but not as much as maybe was thrown out there at times in the campaign trail.
And how much revenue our country can make again, like say with energy, that matters as well. So what are your predictions for interest rates for the remainder of the year?
Well, for the remainder of the year, of course, I think the Fed's going to hold steady. But in January, they meet again, and I do expect over time the Fed to start and continue rather that lowering that they've stated. Now, how much soft and poor economic data I think is ultimately going to be the determining factor of how quickly we get those rate lowerings. One thing I have my eye on right now, specifically coming out of the holiday season, really is how much Americans spend. Those retail sales numbers are going to, I think, really inform that January Fed meeting.
All right, that's the next meeting in January. Ted Thatcher will keep an eye on that, and you will help us read into it as well. President of Bright Lake Wealth
Thank you.
Management. Appreciate your time today, as always.